I'm Teresa Bailey, host of In the Money. On today's show, we're talking about the effect increasing interest rates can have on your family's bottom line. Earlier this year, CNBC reported that the average American carries a credit card balance of $6,375, up nearly 3% from last year. This was according to Experian's annual study on the state of credit and debt in America. Total credit card debt has reached its highest point ever, surpassing $1 trillion in 2017, according to a separate report by the Federal Reserve. Joining us today is Steve Weaver, Senior Vice President and Senior Loan Officer with Paragon Bank. Steve is going to share with us his thoughts on how rising interest rates can affect both the cost of the funds you borrow as well as the income you earn on the funds you save. Stay tuned as we sit down to chat with Steve Weaver.
You are watching Germantown Municipal Television, your source for everything Germantown.
Today we're discussing rising interest rates and their impact on your family's financials. Joining us is Steve Weaver, Senior Vice President and Senior Loan Officer with Paragon Bank. Well, thank you, Steve, for joining us today.
Thank you for having me.
Well, before we get started, tell us a little bit about yourself and what you do every day.
Well, I'm a native of Mississippi. I've been in the Memphis market for about 22 years, been in banking for 30 years, and I am Senior Loan Officer at Paragon Bank. So I have helped manage a team of relationship managers that call on clients, develop business, and primarily charged with bringing in loans and deposits and other ancillary products such as that.
Well, great. That makes you perfect for our show today.
I hope so.
Well, you mentioned 30 years that you've been in the banking industry.
Yes.
So talk a little bit about what it's been like. Two separate things, but I think they have a correlation somehow. Interest rates have been on the decline, and technology and the impact of technology has been on the rise. So how have you seen that impact really the banking industry, but also the relationship between the client and their local banker?
You know, technology's had a huge impact on banking, on everything, obviously. Just accessibility through different modes, obviously mobile devices, et cetera. You can have access to your bank 24/7. And I think the ease of purchases, the ease of access to your checking account. You can make a deposit from your phone. And I think that certainly had a positive impact on banking, but I think there's some negatives as well. And certainly with rates being historically low for a long time, I think people have gotten comfortable with low rates and probably have gotten in the habit of maybe spending a little bit more than the family budget may allow, especially with the ease of being able to spend that money on using portable devices.
So you think behaviorally it's had a negative impact on sort of credit card use tendencies?
Yeah, I think so. I think having the ability to buy an item with the push of a button on your phone and never entering in your credit card number, it's automatically saved, or never having to go to the store and swipe a card, which makes it a little bit more challenging. And then you have a product at your doorstep. So I think people have gotten more comfortable with that. And again, with low interest rates, it hadn't costed as much to finance those items as it has in the past.
That's really interesting. What about the communication process between your bank, where it was 30 years ago and today? I know you mentioned it's positive that you can interact with your bank, but I assume you're not answering 2 a.m. phone calls with your clients.
Correct. Technology does allow us to communicate quickly with our clients, but it has removed a lot of the relationship piece. So you can still conduct check cashing, obviously make deposits, do repetitive transactions remotely. But I do think it's had an impact in the relationship that bankers have with their clients. And so when you separate those two, you tend to reduce the relationship, and there's a lot less room for advice going back and forth. questions, open-ended suggestions, things of that nature that may keep a family or an individual or even a business out of hot water, so to speak.
Well, I'm glad you brought the advice up. So how do you feel about your ability now to be proactive in seeing one of your clients' issues may be coming, that they're overspending, versus being reactive? Has technology sort of affected your ability and the time you spend?
Yeah, I think we all become more efficient at our jobs. Unfortunately, we've got these extra hours in the day and we spend it working even harder. We're all very busy. But I think to a certain extent, it has allowed us to communicate more clearly with quicker pass of information from device to device, email, and face-to-face, but also commercial banks are able to go reach out to their clients face-to-face and take the technology, take the bank with them. So I think that's made it a lot easier to communicate and show them, sit down with them side by side and share that information. So there has been some good to it as well.
So you've been able to leverage that technology.
Sure, absolutely.
So back to interest rates decreasing, and now we're going to see an uptick. They're
Sure.
going to start to increase again. How do you think that that's going to affect your ability and sort of the advice that you're giving to your clients?
You know, we try to be a little bit proactive about communicating with our clients and making sure that each one has a plan for changes in the environment, whatever that change is. For technology, it can be a great thing, but also you have, with the increase in interest rates, that's money right out of the budget of a family.
Oh, the B word.
Yes, the budget, the B word. So I think it's been, it'll be interesting to see how people respond. I think because the economy is doing so well, rates have been ticking up really for the last almost 2 years now. Prime is 2% higher than it was 3 years ago. So because the economy is doing so well though, and people have full employment and people have absorbed that interest expense a little bit more than they normally would. So it's good news that rates are rising because the economy is doing so well. But the bad news is it is costing them money.
And just for people that may not know out there, why are interest rates rising? Who's in charge of that and how does that work?
Well, the Federal Reserve Bank is in charge of our setting short-term interest rate targets, and they do it through the Federal Open Market Committee. They meet 8 times a year and basically look at the economy to see how things are going, how is unemployment, or are we growing too fast? Is inflation at risk? And so based on that data, they make a decision whether or not to leave rates the same, increase them or lower them. And just recently, they increased the federal funds rate by 0.25%, which is now up to 2.25%. And for most people are familiar with prime rate. Prime is usually 3% higher than that. So prime rate now is 5.25%. So that's a good 2% higher than what it was 3 years ago, which does have an impact.
So in your world, is that like popcorn day where everybody's sort of sitting back waiting, for the meeting minutes to come out and figure out what's going on?
It is intriguing. It's intriguing. When rates, prime was at 3.25 for almost 7 years. So I think a lot of people, bankers probably too, got lulled to sleep with prime being at 3.25, rates being low, and cheap money being available for a long time. So it has grabbed our attention, and I feel like we're headed in the direction of paying more attention to it, I guess.
Okay, so we're going to wake up a little bit.
Right, hopefully so.
Great. We'll have to take a short break, and we'll be back in a moment with Steve. Stay with us.
How long have we been married there?
For 76 years.
He was kind and generous to me before we married, and he was kind and generous to me all these years. We decided on Meals on Wheels because I was getting to the point where I couldn't do all the things that I had been able to do. We're the Spans. America, let's do lunch.
Drop off a hot meal and say hello. Volunteer by donating your lunch break at americaletsdolunch.org.
Todd's a great guy. I mean, look at him. What a sweetheart. Attaboy. Wait, Todd, what are you doing? How totally selfish and un-Todd-like of you. Come on, Todd. Come on, man.
You are watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. If you're just joining us, we're talking about interest rate increases and their impact on your wallet. Today we're joined by Steve Weaver with Paragon Bank. Thanks again for being here and taking a break from your busy day.
Thank you.
Well, when we last left off, we were talking about how we're going to now be waking up from a little bit of a daze of this low interest rate environment. So I'd love for you to talk a little bit about what that's going to mean to borrowers and how higher interest rates are going to impact their income, their balance sheets, and your conversations with them along the way about that.
Sure. Certainly it impacts both individual and businesses, and I guess hitting the individuals first. Families, I think you mentioned earlier some data on credit cards, which most credit cards are floating rate credit, already at high rates on average. And so as rates go up, that monthly interest expense goes up. You usually don't notice it. They will send you a notice in the mail, but a lot of the verbiage is buried in your statement, and maybe folks are having sticker shock on seeing the numbers. But for the most part, that interest expense is going to go up every month, and your minimum payment typically goes up as well. So it does eat into the family budget.
So what are some of the conversations you're having and ways for people to sort of keep that in mind and things they may want to consider about that floating rate debt?
Well, people, I think consumers, again, got lulled to sleep over a long period of time of having low interest rates. As budgets, they got comfortable with that, and maybe they started borrowing a little bit more because it was cheaper. So as rates rise, that monthly payment goes up. I do believe people need to pay attention to their growing balances and do their best to reduce those higher interest rate loans first. Maybe they have a car loan. Well, the good news is it's typically a fixed rate. Maybe they have a mortgage. They bought a mortgage when the rates were low and they've got that rate locked in. But a lot of people have home equity lines as well, and I think that's typically a floating rate credit, so that interest expense is going up. So we're just trying to caution people to make sure that your budget for 2019 in particular is allocating for higher interest expense.
And so is there anything that they need to think about as they look at their mortgage balance and their home equity balance? Is it time to refinance again? I know there was a huge wave of refinancing once, over, I guess, really the last decade.
Sure.
Is it something they need to look at again?
It depends on when their mortgage comes due. If it's coming due soon, then obviously they're going to be faced with refinancing. But a lot of people locked in for a long period of time, so 20 or 30 years, and they probably are at an attractive rate. But I would say if they're not and they anticipate rates to go up, continue to go up, just talk to your banker, ask them their advice on what do they anticipate, how do long-term rates, what is the outlook there, and is now a good time. And then you also have the floating rate credit on home equity lines. If you're not comfortable with the balance on your home equity line, that rate's going up, then certainly interest expense going up. Try to knock that down. Attack your floating rate credit first.
Okay, so relationship with a local banker can help you run the numbers on, if you have a primary mortgage and maybe you're happy with that number, but you have a home equity line and maybe you're unhappy with that number,
Sure.
Whether it makes sense to try to do something and combine the two.
Exactly,
Okay,
right.
so that's a type of planning then that people have begun to miss out on by doing everything digitally. Would that be correct?
Yeah, that's correct. And I think, again, the mobile phones and whatnot has taken a lot of the relationship away from the bankers and their clients. But I think it's good to sit down with your banker at least once a year, talk about your budget, talk about what you foresee, and make a plan. And I think there's something to be said about the advice of others. I usually tell people, surround yourself by experts in other fields, then you can do what you're paid to do on a daily basis and let them worry about the details.
And speaking of business, what about business owners and the cost of borrowing? What are some of the things that they really need to be thinking about anticipating 2019 and beyond?
You know, both floating and fixed rates have gone up and continue to rise a little bit. Obviously, a lot of businesses work with operating lines of credit. They have open lines of credit with banks that are typically tied to prime, and so that interest expense is going up. I think right now everybody's enthralled with the great economy that we're in, and maybe they are not paying attention to the bottom line. They're looking at the top line revenue growth. So I think they really need to pay attention to that and forecast maybe a 50, 75 basis point increase in that floating rate over the next year and see what that does to their budget. And then and also make sure that they've invested long term in their fixed assets, whether it's equipment, machinery and equipment, or real estate. And hopefully they've made those investments when rates are lower. And if they haven't, while they still have some excess cash and maybe some revenue and cash flow is good, go ahead and make those investments now.
So in planning with small business owners, are you finding that you're taking into account also where we are in the market cycles, that we're now in the mature part of a market, and sort of how rising interest rates and tightening may, affect small business owners?
Yeah, absolutely. And I think the key there is for small businesses to put money back for a rainy day. I think building equity in the company, obviously paying down debt as they grow their assets and their liquidity is certainly the right move to make. If we don't see any sign of a recession in the near term, but if it does hit and the revenues fall, then you've got money for a rainy day and certainly have a cushion for if your business does see a downturn.
Now, I've heard somewhere that if you think your business in particular may be headed towards sort of a cyclical tightening, to go ahead and talk about lines of credit prior to the need. Go ahead and have one open. Can you speak a little bit about how that works for a small business? Should they always have a line of credit available, or what is your advice in that area?
You know, it depends on their liquidity. I think if they have good cash reserves and good capital in their business, they don't necessarily have to have a line of credit. But if it's a newer business, and forecast what a 10% downturn in revenue does to your business, what does that do to your cash flow? Are you going to need cash? And so talk to your banker about having an available line of credit available. And certainly just having one that is affordable and accessible. But try not to dip into it too early.
Got it. So save it till you need it.
Save it for a rainy day.
Got it. We have to take another short break. We'll be right back with Steve.
Patriotism. It inspires passionate debate, and it's worn like a badge of honor with good reason, because it means love and devotion for one's country. But what really makes up this country of ours? It's the people. To love America is to love all Americans. This year, patriotism shouldn't just be about pride of country. It should be about love. Love beyond age, sexuality, disability, race, religion, and other labels. Because love has no labels.
Every year, 40% of all food in the U.S. never gets eaten.
40%. That's almost half the food we produce.
Food waste is a serious problem. It impacts all of us.
And it's expensive. Your family is throwing $1,500 a year in the trash.
We're working hard to put food waste on the chopping block.
And you can do the same at home.
Learn how to cook it, store it, and share it.
Just don't waste it.
Go to savethefood.com.
You are watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. We're discussing the impact of rising interest rates for you and your family. So Steve, when we left off, we were talking about all the bad things about rising interest rates. We talked about how it, can impact your budget, and you have to plan for all of these bad scenarios. Let's talk about the good news of rising interest rates, and that would fall in the lap of those that save. So tell us a little bit about the impact of rising interest rates on savings accounts.
Well, for years, as we discussed earlier, rates were low, and fixed incomers would come to renew their CDs and had sticker shock at renewing a CD, a one-year CD for 0.4%. And so banks typically had to apologize for that. With lending rates so low, wasn't enough margin to provide the higher interest rate for savers. But now that rates have gone up, CD rates and savings account rates are going up, and that's been a positive for those fixed incomers, and I think really helped those that are near or in retirement to have a little bit of interest income rather than the interest expense.
So interesting to mention retirees, and especially baby boomers, as they sort of, you hear about how large that audience is and how they change everything as they come through it. So as we look at rising interest rates on retirees and baby boomers who probably have the least amount of variable rate debt, could it be net just good news for them that interest rates are going up?
I think it could. Not everybody's in a great financial position when they face retirement. So for those that aren't, again, focus on paying off that remaining balance on your credit card. Talk to your financial advisor, your CPA, but pay off your mortgage if you need to. But I think it's on net good news for those savers, and should help their interest income.
Well, that is good news.
Yes.
So one question I have personally, how negotiable are the CD rates from bank to bank? Is there wiggle room? I hear a lot of people spend time going from bank to bank. Is it pretty set, or in that relationship with your banker, do you have some flexibility?
I think you have flexibility. If I were an individual and approaching my banker, first of all, I'd probably want to go to the bank that my primary account is at. It gives you a little bit more bargaining power. And just ask them what do they think they can do. Your stated rate is whatever it would be, 1.5%. Is there a way you can give me 1.75? What can I do to get a higher rate? So yeah, everything's negotiable and to a certain extent. And we're in a hyper-competitive market. Memphis is saturated with banks, which is a good thing for the consumer. So I would just encourage those to shop around, but talk to your banker. Make sure you have an individual that you go to, and just get the truth and the transparency out of them.
So speaking of the relationship with the banker, what are some of the questions you should be asking to figure out if it's the right bank for you and it's the right banking relationship for you?
I'd say most banks are accessible by technology, and so I think the location of the bank is less important than it used to be. But I would just make sure it's the right fit personally. Again, I firmly believe that everybody should have a relationship with a banker, and somebody that they can call and ask for advice. It can be off bank topic, but on. And just make sure that they're giving you an opinion that you feel like is the truth. But also, if they're steering you to other opportunities, then I think there's something to be said for them being transparent, saying, you know what, I don't have the best rate for you now. I don't blame you for going after that particular account at that other bank, but please come back and see me. I'd love to help you out in the future. And I think if you're getting that from your banker, you have a good one.
You have somebody who wants you to get the best of what's available out there, whether it's at your bank, your current bank, or not.
Absolutely.
Well, that's good to hear. So one thing we didn't get into, and I do want to make sure we touch on, is on the business owner side, commercial real estate transactions. I know that that's probably more complex than the standard consumer buying a home.
Right.
Where is the value in having a relationship for a business owner year over year with the same banker, in the same bank as you start to do real estate transaction work?
I tell business owners that, it's not a one-off transaction. It's not like a home. You're going to buy it and probably going to live there 7 to 10 years. You may be in a lease situation you want to build or acquire. And usually those loans are shorter term, 5, 7, 10 years max. And so you're going to be revisiting your banker, and it needs to be somebody who you have a good relationship with. And oftentimes bankers understand the location, the market, land values, resale values, and things of that nature. And I think it's important to get that advice from them. And so, again, I would encourage them to go to their core bank, whether they have the checking account, operating a line of credit, or equipment loan with, and spend some time with them and just throw out ideas and look at their budget and make wise decisions that way.
Have you seen any kind of technology influence in that market? It's easy for a consumer to see where technology has sort of changed the banking relationship. On the commercial side, especially the commercial real estate side, has technology changed or that relationship, or is it still pretty pretty standard for what it's been the last few decades.
You know, I think it has changed. I think it's made our world smaller between real estate brokers, developers, bankers, and business leaders, business owners. And so I think it's made it smaller, so the accessibility and information about each property that is available is ready at the fingertips. And so I think it's made the cycle a little quicker for businesses that are expanding.
So as interest rates rise, back to that, which is the subject today, it sounds like the ripple effect in commercial real estate has caused that relationship to still be there pretty tight. The planning part of it is going to be more than just the singular impact you see on the consumer side.
Definitely. I think there's a deeper relationship involved in business owners between the president, CFO, and the banker. And again, the closer the relationship, the more transparency, the more forecasting that's involved, the better. Everybody benefits. And you know, again, it's about reducing risk, and as you said earlier, preparing for what may be you know, a hiccup in the future.
Are there any red flags that a business owner should pay attention to in that kind of relationship where they may want to consider looking for, you know, their banking relationship?
You know, I think just a one-off offer from a rate special type setup from a bank. Be careful of that. Get some advice from maybe others. Have the banker provide references of other people that they've dealt with that they'd be willing to share that information with. I think
people you always hear that, the references thing, but people are very timid to ask. What does that look like? And when someone asks for a reference from a bank, how many people, do you do that very often, and why do you feel it's important?
Well, I think information, just the Bank Secrecy Act is obviously impacts our lives on a daily basis, and so we have to have our clients' permission to share that, yes, we did help this individual business out. And so we just have to be forthright, and I usually encourage them. You know, I have a couple of clients that are certainly willing to share their experience with me, with you, to make you feel better about it, and feel free to ask around. I think we're still in a big small town, and word of mouth goes a long way.
Well, that's a great tip to leave with today. Thanks again for joining us, Steve. We appreciate it.
Thanks for having me.
Today we discussed the many ways interest rates can affect your financial plan. Also, that working closely with a local banker like Steve can help you manage the details of an interest rate increase. That's all the time we have today. Thanks to Steve Weaver with Paragon Bank, and thank you for watching. If you'd like to see more shows, follow us on YouTube or Facebook at Germantown Municipal Television. You can also visit our website at gmtvonline.org. Each person's financial situation is unique. Before making any decisions, please speak to a financial professional to see if our discussions today are in your best interest. We'll see you next month. I'm Teresa Bailey, and now you are in the money.